Hi, Gabriel and Josiah here again. In this session, we take a deep dive into the world of financial metrics. We are unraveling the trade receivables turnover ratio. It's a crucial tool that measures how efficiently the company collects money owed by customers. This ratio not only highlights the effectiveness of a company's credit policies, but also play a significant role in maintaining healthy cash flow. Whether you're an aspiring accountant or a chartered accountant in training or a seasoned professional, understanding this ratio is vital for successful financial management. Let's break down the formula and uncover what this metric truly means for businesses and your future in accounting. Let me share my screen as our custom, and let's take a deep dive into this ratio very graphically. It's a very interesting ratio, and it has to do with trade receivables turnover ratio. So my screen is coming up right now, and I'll just share it in a jiffy. Let's see how to describe ratio very graphically. Okay, so I've gone mini-me now, and talking about the trade receivable turnover ratio, it measures the average number of times credit sale has been created and payment received from customers during the year. So your trade receivables has to do with debtors, as it's traditionally called. So there's the cash sales during the year, and that does not necessitate any receivables. But the credit sales that expands the revenue base of the company necessitates receivables or tracking or follow-up of debtors to get back the funds in form of services and goods provided to the clients or customers of the business. So a sale is created and payment is supposed to be received at a later date during the year. So this turnover ratio measures the average number of times that such sales are created and payments are made and received from customers. It measures how efficiently a company collects its receivables or the credit it extends to customers. So the efficiency of how fast, how effective the collection procedures and timeline is essential, and that's what this ratio speaks to. It shows how many times during a period the company collects its average accounts receivable balance. This ratio is important for evaluating how effective the company is at managing credit and collecting payments from customers. This is very important. So the measurement of how fast and how effective management and the company, the theme of staff on this ratio, evaluating it, it's very important this ratio is put to use. So the formula is clear on the screen. We have it as our numerator, the credit sales, and our denominator, the average trade receivables. So if you see, or you had in the previous video on liquidity ratios, you have the receivables collection period, which measure the number of days it takes to recoup inventory or recoup receivables, I beg your pardon, in form of credit. So the number of days is different from this ratio. Now, this ratio is an activity ratio that measures the efficiency and how many times management is able to get or generate the receivables and the rate at which efficiently management is getting back the funds. This is very important. So we have it as formula on the screen showing net credit sales, and we have the denominator as the average accounts receivables, where the net credit sales shows the total sales in the year, in the period made on credit, while the average accounts receivable is the beginning accounts receivable, ending accounts receivable. So where the beginning is not provided, you just take the ending as the figure to measure this ratio. So let's look graphically into our example as we've always done. And let's calculate this ratio, which is simple. So our numerator that has to do with our average receivables, it's gotten from our SCI, which is the income statement. So let's go get our credit sales. Our income statement, which is our numerator. So our sales figure for 2020 is 1.2 billion. And don't forget, there's a note or a caveat here that states that of the yearly total revenue, 75% was made in cash, while the balance was on credit. So what's the balance? 25% is the balance. So we take 25% of our sales revenue to express that as our credit sales. Very, very simply. Okay, so let's pick that. Do the maths here. If you have a calculator, please follow me closely, and we are going to calculate this ratio very, very seamlessly. So let me pick this Naira figure here. Very important to show that this is the actual value of what we are doing. Okay, so we have the sales revenue. Now let's have credit sales. Credit sales is our total sales by 25%. So our credit sales is 300 million. Very, very simple. So from our formula on the screen, you could see that we already have our net credit sales. So let's get our average accounts receivable, which is the average accounts receivable in the beginning and the end divided by 2. So our accounts receivable from this question can be gotten from our statement of financial position. So we have our trade receivables. Our trade receivable at the beginning is 400 million naira, and the ending is 470 million naira, depicting practically an increase to start and the end of the year. Okay, so take that, we have it here as our trade receivables. So let me have the beginning. So the opening, we just make it for short, abbreviate it, have the closing. So our receivables is the total figure, the opening and the closing. Very simple. Add it, have 870. And our average receivables, simply the receivables opening and closing divided by 2. We have it as 435 million naira. So let's calculate our trade receivables turnover ratio. Let me abbreviate that. Permit me to abbreviate that. So we have that as our total credit sales divided by our average receivables. That gives us total 0.69 times 0.69 times. So it's less than 1, and it shows the rate at which receivables are turned over in the course of the year or in the period under review. So 0.69 times less than 1 is our trade receivable turnover ratio. So what does this mean? Let's describe this. What does this mean? So this ratio indicates how many times a company collects its receivables during a given period. It suggests, when it comes to a higher ratio, that the company is collecting receivables efficiently. So based on what we've seen, we have it less than one time in a particular financial year. It shows the company is not efficient in collecting receivables. And you could see perfectly from the picture that was painted in the liquidity ratios, you could see that the receivables collection period was over 529 days. If I could remember, you could go back to the video to validate that claim of 529 days, which is over a year plus. And that is why the turnover ratio here is very low. So this indicates difficulties in collecting payments or inefficient credit policies. A high receivable turnover ratio implies that the company has efficient credit management practices and is quick to collect payments from customers, which improves cash flow. While a low one, like we just saw, less than 1, about 0.69% or 0.69 times, I beg your pardon, indicates that the customers are taking too long to pay, increasing the risk of bad debts and tying up the company's cash in receivables. Don't forget, the receivables are part of the current assets that runs the company on a day-to-day basis. So if it's tied down for too long, then you have a working capital problem. The operating cycle will be very, very bleak and slow. So what is the cause and effect? Now, a high receivable turnover shows strict credit policy implementation and proactiveness in ensuring these receivables are recouped. Efficient collection policy processes or strong customer payment discipline. So these are the causes of high receivable turnover, especially if it's above 1, 2, 3. This is the cause. What are the effects? It improves liquidity. Like I said, the receivables are part of what you run your day-to-day activities. So your liquidity is in a better position, and this effect is vivid here. Shows also cash flow management and reduce risks of bad debt. So these are the effects of a high turnover receivables turnover ratio. While the causes of a low one is lenient credit terms, poor collection practices, lack or no credit policies, or financially troubled customers. And this culminates in inability to pay where you have financially troubled customers. And the effects is clear. Increased risk of bad debts, strained cash flow, and high working capital needs. These are the effects. Okay, so in conclusion, the trade receivables turnover ratio is a vital indicator of a company's effectiveness in managing its credit sales and collection processes. No matter how insignificant or low the receivables are compared to cash sales, it's still the revenue of the company and should be recouped to improve profitability and ensure the company gets back its dues. This is very important. So a high ratio demonstrates strong cash flow and credit control. Credit control is a very powerful word in receivables collection. While a low one can signal potential issues with collecting payments. So maintaining an optimal turnover ratio ensures that the company can manage its cash flow effectively while balancing customer credit needs. So this is very, very important. Now you have it. You've seen and explored the trade receivables turnover ratio. You can see how it serves as a vital indicator of a company's financial health. Remember, a high ratio reflects efficient and effective credit management and robust cash flow, while a low one can signal potential cash collection challenges. So as you apply these insights in your studies and future careers, strive for the balance between extending credit and ensuring timely collections. This is very important. Don't forget to like, subscribe, and hit the notification bell for more essential accounting insights. Keep honing your skills and mastering those metrics. And until next time, bye for now.